Hi, I'm Greg Coulter of Just Analytics. This is the detailed 8-minute version of my video that walks through and demonstrates the value of Tier 1 investment funds for your typical pension plan. I know from personal experience pension plans struggle with the age-old dilemma. Do we focus on reducing the risk in our portfolio, or do we focus on improving the return in our portfolio? Simply put, the value of Tier 1 investment funds is that they will do both. Reduce the risk within the portfolio and improve the portfolio's rate of return at the same time. You get the best of both worlds. Before we look at the examples in detail, we need to cover off a couple of assumptions. First, all returns are net of fees. Secondly, we use an index ETF as the comparison baseline. Thirdly, all results, standard deviation rate of return, are based on the 5-year period ending the 30th of June 2020, and the investment growth is based on an initial investment of $100 million over a 5-year period. So let's look at the first example, the baseline. This is an index portfolio comprised of pure exchange-traded funds with an asset allocation of 30% U.S. bonds, 40% U.S. equity, 10% U.S. real estate investment trust, and 20% global equity. The portfolio standard deviation is 11.64, the rate of return is 7.29% per annum, and the initial investment grew by $42.2 million over 5 years. If we replace the ETFs with Tier 1 investment funds on the right-hand side of the screen and retain the low-risk bond ETF, then the portfolio standard deviation is 14.17, 22% higher than the index. The rate of return is 13.62%, 633 basis points higher than the index rate of return. The initial investment grew by $89.4 million, so 47% more than the index. That's not the end of the story. I'm sure some of you are going to say, Greg, the risk of this Tier 1 portfolio profile is too high for our pension plan. No problem. That's why we blend the Tier 1 investment funds with the low-risk bond ETF. We can now customize the level of risk in your pension plan's portfolio. Let's do a second example. I keep telling you that Tier 1 investment funds will improve your rate of return by an average of 2% per annum. So let's do that and see the results. We increase the bond asset allocation to 70%. We get a rate of return of 9.47%, which is 218 basis points higher than the index, so slightly higher than our target of 2%. We reduce the portfolio risk from 11.64 to 10.09. That's a 13.3% improvement. The investment growth with the 9.47% rate of return is $57.2 million, which you can see on the next screen. So that's an incremental return of $15 million over 5 years. It's 15% better. The net result is 13% less risk, 15% more return, for a combined risk and return improvement of approximately 28%. Okay. Let's do a risk-focused example. Assume you want your Tier 1 portfolio to have the same risk as the index. So, by increasing the bond asset allocation to 60%, 35% of it in bond ETF, 25% in the Tier 1 bond fund, we marginally reduce the risk from 11.64 to 11.19, so a 3.9% improvement. The rate of return is now 10.74%. This is 345 basis points higher than the index rate of return. The investment growth with the 10.74% rate of return is $66.5 million, as you can see on the right-hand side of the screen. So 24% improvement from a return perspective. So your combined risk and return improvement, again, is approximately 28%. Maybe your pension plan consultants are anticipating a second COVID-19 negative impact on the stock market, thus you want a lower risk profile for now. So let's go do a low risk example. We increase the allocation to the bond fund to 70%. We reduce the portfolio risk from 11.64 to 8.24, a 29% improvement. Our rate of return is 8.33%, so roughly 1% better than the index. The investment growth is $49.2 million, thus generating $7 million in incremental return, a 7% improvement. And you can see that on the graph on the next slide. So, The net result is a combined risk and return improvement of approximately 36%. Let's do one more ultra low risk example. If you said to me, Greg, let's reduce all the Tier 1 funds down to a 5% asset allocation and put all the remaining monies into the bond fund. So you have 80% in the bond ETF and 5% in each of the Tier 1 investment funds. We reduce the risk from 11.64 to 5.59. That's a 52% improvement. Clearly, we're now at the point where we are negatively impacting the rate of return because it's dropped from 7.29 in the index portfolio to 6.32 in this portfolio. At the end of the day, it reduces the investment growth from just over 42 million to just under 36 million. So it's $6.3 million less, so it's 6% less of a return. When we combine that with the 52% reduction on the risk, we actually end up with a combined risk and return improvement of over 45%. So we've done 4 different examples. On each and every one of them, when you look at the combined risk and investment growth improvement as a percentage, we are north of 25% on each of the 4 examples. I'm sure some of you are looking at this thinking, wow, does this actually work? Can it really be this simple? First off, I want to assure you that this does in fact work. I've done this over a time frame of 25 years with 3 different employers with 6 different pension plans. They ranged in size from a couple $100 million to in excess of $10 billion of assets under management. On each occasion, we were able to improve the funding level of the plan by at least 1% per annum. The reason it looks simple is that the hard work has already been done. That's identifying the Tier 1 investment funds. You'll recall that the investment funds have to pass rigorous analytics with respect to risk, return, and repeatability. Think likelihood to outperform. Roughly 1 in 25 investment funds will pass all of the analytics and be rated Tier 1. So effectively, you're getting access to the top 4% of investment funds. It's the best of the best. Together, we can go build you a custom portfolio utilizing these Tier 1 investment funds and the low risk bond ETF so that you can significantly reduce the risk of your portfolio, significantly improve the rate of return of your portfolio, or a combination of both. The choice is yours. I'm sure you'll have questions after watching the video. Please feel free to reach out to us. Send us an email, greg@justanalytics.ca. We'll set up a time for a no-cost, no-obligation consultation. If you want a copy of the Excel spreadsheet that we use in the examples in the video, again, send us an email. We'll be more than happy to send a copy your way. At the end of the day, I want you to see the value of our product offering before we sell to you. I want you to truly understand that Just Analytics can help reduce the risk and improve the rate of return for the investment funds within your pension plan. I am confident that we can get you a 20% improvement. As always, thanks for your time and attention. Have a great week.